All right, so I hope we're recording. Yeah. So, as promised, I'll be doing a short video on market structure. Okay, market structure is very important in technical analysis. Why? Because it helps you to know where the market is coming from and where the market is going to. So basically, there are 2 or 3 types of trends in the market. We have the uptrend, the downtrend, and when the trend is neither, or when market is neither moving up or down, we call it consolidation or ranging market. Okay, market is either trending up, down, or it is consolidating. All right, so today we're going to look at market structure and how we can make use of market structure to ascertain our market bias or daily bias of where the market is going to and where the market is coming to. Understand that market structure is one among many things that is needed for you to use in order for it to become profitable. So there are other factors, okay, but let's start with market structure for now. So basically, when we talk about market structure is simply the creation of higher highs, higher lows in the market. It's as simple as that. Okay, now when you look at this structure here, now it clearly shows you that the market is trending up. Why is it trending up? Because the market is making series of highs. Can you see these highs? The market is making series of highs, that's higher highs, and then it's also making series of higher lows. The lows are getting higher, just like a staircase. So whenever you see a trend like this, you know that that the market is bullish. It's as simple as that. And the same thing applicable also whenever we have something like this. So we know that the market is the market is trending downwards. Why? Because the market is making series of lows. As you can see, this low is lower than this one, so we have lower low. This high is higher than this one, and this high here is lower than this one. So we have series of high and lower highs. So this lower high, so the next high that is going to be created will definitely not pass this one, but within this range from here to here. So we might have something like this. Then whenever we now have something like this, that is when we now know that our trend has changed, or there is a change in trend. Whenever we have our previous high or low violated. So if this high gets violated, as you can see, it's even violated 1, 2, which means that the trend has changed from bearish to bullish. And this is what we now change, what we call, or what people call change of character, right? Change in trend, whatever name you want to call it. I don't really care about names. All I care about is the principle behind whatever the market is doing. So the idea is whenever market shifts its structure, we see that market was coming from here, lower low, lower high, a lower low, a lower high, a lower low, a lower high, a lower low, and suddenly you are supposed to have a lower low here, a lower high here that will come down here, but market refused, and the market broke this high and broke this high, which indicates that market has changed trend, and that means that we should expect something like this, right? And then market will now continue in a bullish direction. Likewise, in our downtrend, whenever market is making higher highs, higher lows, higher highs, higher lows, higher high, higher low, and then suddenly market decides to do this. Whenever you see this tells you that market is no longer bullish. Okay, the market is no longer bullish. So we have this before our uptrend, but market took it out and broke structure. Higher high, higher lows, higher high, and then we now have a lower low. So which means that our trend has changed, and then we should expect something like this to begin, and that is how you understand what the market is doing. So everything we have discussed here, we are going to look at it in the charts so that we can have a better understanding of it. Let me just clear this out. All right, so let's look at market structure on our real chart example. Now, whenever we are dealing with market structure, I like us to understand something, that time frame matters. Okay, your time frame matters, and if you're dealing with market structure, it is important for you to start with a higher time frame, because the higher time frame will always control the lower time frame. The higher time frame tells you where the market is going on the long time. So when you know the direction of the market on the long term, then you will be able to, trade in line with the long time market direction. Yes, you can take trades in the short to wide if you're a scalper, depending on the type of trader you are anyway. If you're a scalper, you can look for trades on the lower time frame. Understand that market is fractal. What happens on the higher time frame happens on the lower time frame as well. So now this is a daily time frame, which to me is more than enough, or you can as well look at the weekly to see what is happening. Now when we look at the weekly time frame here, we observe something, that this is gold weekly time frame. You observe something that previously gold is still trending up. Let's start from here. You can see this high, right, to this one, to this high, to this one, to this one. This one didn't make a new high though, but as you can see, this is gold. So you observe something, that gold on the weekly time frame has been bullish, right? Gold on the weekly time frame has been bullish. So if I bring this out now, and let's analyze the anatomy of. All right, so gold, as we see here, the market has been trending upward, higher highs and what, higher lows, higher highs and what, higher lows. Now if you look at this, although this looks like a broker structure, right, this one here, this looks like a broker structure, but it is not. I think there's a mistake from what I drew here, because this high did not take this one. So let me delete it and draw a better one, right? Let me delete this and draw a better one, because this high, so we start from here to this place, right, to now this high here, as you can see, this high did not take this high, this one here, yes, did not take this high. So we are not going to consider this as a low. So that means this should be from here to here and what, and here, okay, because this high didn't take this high, so we are not going to consider this low. That means this low is not a valid low. This is the valid low, because this is the valid low that took. So this one take the previous, I guess it did. So we take this high from here, okay, I don't know, okay, so we take it from here to here, right, like that, and then market is bullish. So now this is how you will draw your trend and then understand what the market is doing. So on the weekly time frame, you discover that market is still making what, series of higher highs and higher lows. So this tells you that on our weekly time frame, what, gold is bullish, and that is why gold has been pushing higher and higher and making new all-time highs almost every month. Okay, now this is the weekly time frame, by the way. So when you're done with the weekly time frame, remember we are not taking trades on the weekly time frame. Okay, we only use these time frames to understand what the market is doing or where the market is going. Now I'll come to the daily time frame. When I come to my daily time frame, I'll not start marking here again. No, I've already done that on the weekly. Okay, that is what I'm trying to say. I'm not going to start marking here, this. Nah, I'll not do that. Okay, I'll not start marking those ones, because those ones are irrelevant to what Those ones are irrelevant. So what I will do when I come to the daily time frame, I'll just look at the most recent price action, which is what, probably just few months. 2 months is okay. So when you look at the most recent price action on gold as well, you discover that what, gold is still bullish on the daily, because gold is making series of what, higher high. This is not the weekly time, this is the daily time frame. I'm teaching you how you can make use of what, the time frames to do your analysis. This high didn't take this one, so you're not going to use it, right? So we use this one. This is the high that took the low, and then we use this one lower than the other one. No, it's not lower than it, so we use this one that is lower. Okay, now on the daily time frame, you discover that gold is still bullish, right? Why? Because gold is making series of what, still making series of higher highs, breaking market structure to the upside. So since gold is still breaking structure to the upside, all it therefore means is that what, gold is still what, bullish on the daily time frame. So what should I do as a trader? That means I should look for what, buys. It means that buys will be more suitable for me to enter than sells. Okay, now this is regardless of the strategy you are using. No matter the strategy you are using, gold is bullish on the daily and on the weekly. So if gold is bullish on the daily and the weekly, your strategy should be looking for what? Look for buys. Okay, and we're not talking about entry, we're not talking about how to enter. We're all discussing on how we can know where the market is going. So now that I know that the market is bullish, okay, you can still go down to your H4, your intermediate time frame. Even on the H4, you discover that market is still what, is still bullish, right? Yeah, just that from here, market is from here, we can say the market is what, market is ranging. So you might not really see a good entry from here, right? But know that overall that gold is still bullish. So any day you wake up from the market, what should you be looking out for? You should be looking out for buys. So if you see a sell setup, know that that sell setup is actually a setup, okay, for you to blow your account, because you are likely to take losses when you are selling gold than when you are buying gold. If you are buying gold, you are buying in line with the weekly and the daily trend. So when you are buying gold, you discover that your wins will be more than your losses, because you are trading in line with the trend. So when you trade in line with the trend, you are going to take less losses and do less mistakes. Okay, so right now gold is just ranging. Okay, so depending on your strategy, there are people that even with this range, they can still get something off of it. Okay, yeah, you can still get something off of it when you go to some time frames lower, right? Remember I said depending on your strategy, the strategy you're using, you can still get some stuff. Last week there was a beautiful sell. After this you can see there was a stop hunts here. I saw the stop hunts, and then there was a break of structure. Remember, we are not going into what the market is. I just want to show you that with your strategy you can still get something. Now I checked the higher time frame. There was a POY on the higher time frame here, and the market just tapped into it here and then sold off. So, and there are entries. Even right now I can see some entries, stop hunts, break of structure to the upside, liquidity hunts, and then entry after the take of liquidity right here. So we will come to that. Okay, but for now we are just looking at how we can use market structure to identify the trend. So our trend is what, overall is what, is bullish, and that doesn't mean that the market will not retrace. Market will retrace. So whenever you see the market is selling, you know the market is retracing. So the sales doesn't mean that a change of trend has occurred. The sales only mean that market is breathing. Market is just taking some rest and preparing for the next launch. So we know that the next push of the market will definitely take this high out, because the market is what, is super bullish. The weekly, the daily, and I believe even the monthly are also bullish. So the next push will definitely take this high out. So you can position yourself for that. All right, so that is how you get to know and understand market structure. It's as simple as that. Let's look at another pair. Okay, this is GBP/JPY. I'm looking at GBP/JPY. For market is bullish anyway, but probably market will just retrace. All right, so let's go to the daily and clear everything we have so that we can properly analyze the charts. On GBP/JPY, if you see that market was trending upward, now you don't need a seer, a prophet to tell you that market was trending upwards, right? Right here, market was trending upward, and then suddenly we had this push to the downside. Now you ask me, is this market still bullish, or is this push that we saw here, this push, does it mean that the market is now bearish? Now I'd like you to observe something. After every break of structure, maybe I should just say it here, after every break of structure, there's always a deep pullback to at least 50%. Okay, now how do we validate a proper range? Okay, maybe not today, or maybe some other time. We're going to talk about range so that you will know where and how to anticipate a reversal or a continuation. Now, when market broke this structure here, right? The market pushed upside and then came back. And now, for me to know if this is a valid range, market must come to at least 50% of this range. So when market comes to the 50% of this range, that is when I should be looking for buys. Okay, that is when I should be looking for buys. Likewise, the same thing when market is trending downwards, I only look for sales when market has come to the 50%, or we call it the premium and discounts. Whenever you are buying, the discounts; whenever you are selling, the premium. Okay, of course, probably let me just explain premium and discounts here. Okay, now premium and discounts is simply, when you go to the market and you want to buy something, you want to buy at a discounted price. That means you want to buy when the price is cheap. Okay, nobody wants to go to the market and buy something that is very expensive. We all want to buy something that is cheap. So that is why whenever there is a break of structure, the 50% up is called the premium, while the 50% down is called the discount. So when you are buying, you buy at the discounted level when the price is cheap, and when you are selling, you sell at what? At the premium when the price is expensive. Of course, we're into business to make money. So when I buy something cheap, I sell what? I sell high. You buy low and sell high. So I buy something for 1,000 naira. I will wait when the price has gone to 2,000 to 3,000 naira. Then I will sell. Then I will make my profit. Then I will wait again until the thing has fallen to like 800 naira at a discount price. I will buy again and wait until when the thing has gotten to what? 3,000 naira. Then what? I will sell. Okay, excuse me, let me take a sip of water. All right, so now we buy at discount and premium level. You buy discount, you sell at what? At premium. So when price gets to this level, that is when I'll start looking for what? I'll start looking for points of interest and liquidity and stuff like that to push us toward the next level. Now, if what happens now when price didn't come to this, and then price, let's say, just came here at probably some 50% and broke another structure. Now you see that this one was a complete range, right? Because price came here below 50%, but this one is not a complete range. Okay, now if you measure it with Fibonacci 2, you see that price did not make it to the 50%, right? Price didn't make it to the 50%. Now what this means is that this low you are seeing here is liquidity. is a the low there is what is liquidity. So market will possibly do something like this in the future and then come back to the 50%, okay, and then what, continue. Now someone who is not experienced will assume that what, this is break of what, structure, and then you will go and sell from here thinking that okay, market has entered 50% to almost premium. Oh yeah, sell. You go and put your sell here and then hoping that market will push down, take a profit, and the market will just what, will mess you up. And the market will take, I said, but I thought there's a broker structure here. No, we have left out some details. Now this low did not come to the discounted level of this range, so this low is not what considered a valid or a strong low. So when market broke this structure up again, it's only engineered liquidity to trap traders. Now remember, market broke structure, right? Now some people will assume that okay, since market has broken another structure here, it means that this one is what, is our range, so market will now come here and what, and continue buying. Now you see, when you place your buy here, hoping to take out the next high, right? When you place your buy here hoping to take out the next, so let me delete this so that the chart will be clean. Remember, everything I'm explaining also happens on both, is for both the buys and sells, so I might not be able to do both for the buys and sells. Now market didn't come to the discount level of this range, and it's broke another structure, and people like, okay, since market has broken the structure, let us buy from here, and you place your buy from here. Shh, you got stopped out. Man, then that's okay, market has broken structure again. Now decide to place your sell. Now place your sell from here to sell, thinking that market has broken structure, and then shh, you get taken out. So you buy, you are stopped at, you sell, you are stopped at, and you're like, what is happening to me? It's simple because you are not paying attention to details, and these literally two things are what really matters in trading, because sometimes it's not all those bogus words. Just paying attention to literally two things like this can transform your trading. So if you look at, okay, this low here has not actually come below this 50% to mitigate a reasonable point of interest here. So this low is not a valid low per se. But when market is coming, market can come and sweep it or break it and then tap into the 50 discount level, into a POI here, and then continue buying. So you think that this is a break of structure? No, it is not a break of structure. It is because price has not gotten to the discount level in the initial pullback. So when price broke up again, this is just to trap traders, and it is what the market do every day, to trap traders into thinking that the market has changed structure, and then they want to sell and they are trapped. They bought, they were trapped, selling, they were trapped, and then in both ways you take losses. So but when you pay attention to what the market is doing, you will know how to avoid these mistakes. Okay, let's look at some chart example. So now what brought about explanation of this is when you look at GBP/JPY. This is on the daily time frame. You discover something that on the daily time frame, when we had this low from here to here, market came back at what, more than 50%, right? Oh, sorry. From this low to this low, right, to this low, and then to this one. Now let me stop here for a bit. Now if you measure this with your FIB tool, you discover that markets came down to at least what, 50%, right, into this rejection block, and it's bought. Now this second one again, this is the daily time frame, by the way, so please pay attention. From here to here, markets came back below the 50%, right, very below the 50%. Well, anything within this region, that is where you should start looking for a buy. Your strategy should tell you where and when to enter from and bought. Now when the market took this high, you discover something that this break of structure, the next break of structure here, there was no deep pullback. I don't know if you are seeing it. You should be seeing it. Okay, there was no deep pullback, just a shallow pullback, and then shallow pullback, and then market was just, we call this thing range structure. There was no proper pullback. Can you see that? There was no proper pullback, and all of a sudden, right, market fell and then returned back to where? To this discounted level. Okay, markets returned back to this discounted level, and now what are we seeing now? Market has started giving us another bullish structure. Are you seeing it now? So now market has started giving us another, so we expect to see something like this, and then probably we take out this high. So now you discover that, okay, because this there was a mighty fall, market is now bearish, let us look for sell. No, you must understand what the market has been doing. That's the essence of what? Market structure. Technical analysis, the use of previous price data to forecast the market. So looking at this, you know that the market is still very, very bullish. So regardless of this mighty fall that happened, you know that this mighty fall was just to come and was to return back to the discount level, and then took and it reacted from a particular POI here, and then market is what? The market is buying. Okay, so that is basically it about market structure. Okay, I wouldn't want to prolong this video. So yeah, so that is it. Can go and back test and look at how you can. So now next video we'll be looking at how we can make use of market structure properly to form our bias of the day. But this one we're just looking at how we can know the direction of the market, the long-term direction, the overall direction of the market. Okay, thank you very much. See you in my next video. Bye bye.